If you're looking to buy Mullen Automotive, then please keep watching this video because we're going to look at the company's recent news, how the market's treating the company, and what are the technicals telling us. And more importantly, what is the trading approach? As the market remains volatile, we should always be mindful about which positions we take on, as well as their individual risk factors and exposures. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Mullen Automotive has been trending during the course of 2021, as the share price reached a high of around $15 at one point and even stayed at about $10 for a prolonged period of time. It gathered a lot of hype in the market at the time because EV manufacturers have the potential to send their stock soaring under the effect of the bullish Tesla lasting for about a year. The market has since then been different and people have moved on to other investments, but nevertheless, Mullen does represent some interesting potentials. Its current price point has a very limited downside compared to the upsides. But the question is, how long should the investors wait before the moment happens? For instance, when we look at the stock price back in 2018, the stock took more than 2 years before bouncing back during the special circumstances. I would say that this time the bounce would be less spectacular, but it should happen over the next few years. The trading volume of Mullen has recently been 19 million shares versus an average volume of 60 million shares. Over the previous 52-week period, its price fluctuated between 52 cents and $15.90. The volume of shares traded tells us how many shares are being bought and sold at any point in time and if there's enough liquidity to support a trading strategy. If the float is very thin, stock can be easily influenced, but low liquidity could mean that the demand is also very limited as well. When we compare the current volume against the average volume, there might be a possibility for a trend reversal or breakthrough if the difference is very large. For example, if the stock were to break through, the current volume would be significantly higher than the average. The market cap of Mullen is currently around $360 million versus an enterprise value of about $112 million. Simply put, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, and the enterprise value is the cost the company paid for its assets, paying off the debts. It's worth mentioning that one of the most significant asset types for the growth companies are the intangibles, meaning they might not be items to be used immediately, but they're pledges for a better future, such as goodwill, intellectual properties, and brandings. So for startups, most of their valuations are usually on those intangibles, and if they were valued in better conditions, then what this means that there could be a huge gap between how much the market believes it's worth and how much the books believe that it's worth, giving a false impression to the market that a company is trading at a discount, but it might just be trading below its book value, which might have already been inflated to begin with. As we compare the current price to the historical price fluctuations, the stock is 18% higher than the 1-month low, 40% higher than the 3-month low, and 104% higher than the 52-week low. On the options market, giving a hint about the market sentiment, the implied volatility is 190% versus a historical volatility of 107%. The put-call volume ratio is currently around 0.31, and it is normal for most stocks to have a higher put option volume than what they truly deserve. So, the most recent volume options traded has been 21,000 contracts a day versus the 30-day average of 44,000. In terms of open interest, the most recent volume of open interest has been 400,000 contracts versus the 30-day average of 488,000 contracts. The option contracts are tools allowing traders to hedge their risk, increase their exposure with limited downside, or to have a revenue stream. They are derivative contracts based on the underlying security, giving traders the possibility to buy or sell the security with a predetermined strike price. In terms of the shareholder structure, institutional owners have about 1.6% of the outstanding shares. The biggest shareholders include Vanguard, Citadel, and Susquehanna. Usually, it is best to see some institutional participation when holding a stock long term, which is an important factor to consider for investors. I believe that a minimum threshold should be around 25 to 30%, although there are many exceptions to that rule as well. Let's also take a look at the short interest in the stock, which is the number of positions that will profit from falling stock price. The way it works is that short positions will borrow shares from brokers, sell them in the market, and buy them back later. If there are significant short interest, usually above 25 to 30%, there would be potentials for short squeezes, whereby traders can buy the stock up, forcing those with short positions to redeem them to avoid further losses, which acts as an additional buy for the stock price. This is what people refer to as a short squeeze, and it became a popular concept recently, with stocks like GameStop and AMC been short squeezed. So, I would recommend to buy Mullen in small quantities, and to try to keep the cost at around the current $1. Given the size and the institutional participation level, I would say that the stock should be considered as a marginal position to be included in our portfolio. I would recommend to commit between 3 to 5% of your portfolio in the stock and to further allocate 30 to 40% of your allocation later so that you can purchase more in case it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.